My name is Dan Weiskopf, for those who don't know me. I'm the ETF professor and also lead ETF strategist for the ETF think tank. And today we're thrilled to have Charlie Travers from Motley Fool Asset Management to discuss what he does at Motley and who Motley Fool is, for those who don't really know. They're relatively new to the ETF game, but not new to the asset management business. So, Charlie, thanks for joining us. Welcome.
Thank you, Dan.
So let's begin a little bit by just talking about your bio, how you came across Motley, because it's actually an interesting story. When you told me, I was quite surprised.
Yeah, sure, Dan. I took a unconventional route into finance. When I was in undergrad and grad school, I thought I was going to be a research scientist, discovering drugs. So I did 2 years of research in an Alzheimer's disease lab as an undergrad, trying to understand some of the mechanisms of that disease and develop an animal model. And then I had such a good time with that. When I went on to grad school at St. Louis University, I ended up in a cancer research lab, trying to understand the mechanisms for why cancer cells grow in an unregulated way, which means they just reproduce over and over and over again to become these big masses. And while that was going on, this is at the time when the Human Genome Project was big. And so people, those of us who remember the dot-com era and NASDAQ stocks going crazy, well, the same was happening with biotech stocks as well. You remember companies like Celera Genomics or Human Genome Sciences. Everybody's like, sequencing the human genome, it's going to lead to cures for all these diseases, and all these small cap biotech stocks went bonkers. And so I'm sitting in my lab, working on the cell cultures and all of that, looking at what's going on in the stock market. And I'm like, wow, this is fascinating. And I notice, a lot of the analysts covering these drug company names were people who had MDs, PhDs. And I was like, wow, so there's a track for me with a science background doing this cool stuff. And so I left, academia and scientific research and got hooked on the stock market. One of the reasons for that was it scratched an itch for me where I liked science to actually have an application to helping people, which is what a lot of the biotech and pharma products were doing. At that time was when Genentech had the first monoclonal antibodies approved for the treatment of cancer, which was Herceptin and Rituxan. And, that led to a great story for that company, which ultimately was acquired by Roche. So I came in to the industry, never having taken a business class, never having taken an economics class, but I knew science. I knew critical thinking. I knew how to look at these assets, which are long-term assets that require a lot of upfront investment before they pay off. I think that was a skill I learned, which translated well to being a generalist investor. I cut my teeth in the field by being a specialist, and then over time, kind of spread my wings to look at other things as well.
Interesting. Yeah. A long time ago when I started in the industry, my mentor, I think I told you this, was Charlie Allen, who was the original seed investor at a firm called Syntex that today people don't really know about, but Hoffman LaRoche bought that company as well. And it of course is known for creating the birth control pill, which we all love and appreciate.
Yeah.
Thanks. I love the background. And talk to me a little bit about the team, because portfolio management, is about a team often and leveraging everybody's expertise and a philosophy.
Right. So we have a team of 6 portfolio managers and 3 research analysts supporting us. And that is for our 3 actively managed ETFs and our 3 passive ETF products. So we're a small, tight-knit, boutique little group. And we decided pretty early on when we built that team, we had to all be on the same page as to how we evaluated businesses, have a repeatable process, and we're all going to row this boat in the same direction. And so we built out a process where we look at 4 things every time we evaluate a business. We're looking at the management, the culture, and the incentives. We're looking at the economics of the business, the competitive advantages, and then the 10-year trajectory of that business. So anytime someone on this team has a research idea, they got to write it up within the format of covering those 4 subject areas. And then we're going to sit down as a group and talk about it. And we actually score every company we look at 1 to 5 on all 4 of those categories to see what is investment worthy for our funds. That's our filtering process. So like, for example, a old school cigar butt type investment where, say, the CEO is rating the company's coffers, to make an extreme example, would obviously fail the quality screen we're trying to do. So we're trying to hone in with our funds on higher quality businesses that we think are going to compound value for the long run.
Well, yeah, but quality sometimes is a bit subjective. How do you score quality?
So within each of those categories, we have standards we want to look at. So within and I would say management and culture might be the most subjective of those 4 categories. It's like, how are you scoring the people within a business, for example? And I'll tell you some ways we do that. We look at diversity in the composition of the board. We want a board, ideally, that's not classified. So we want all the directors that are up for election every year. We think that's in most shareholder interest. We tend to frown on like dual share class structures. I'm an old school 1 share, 1 vote kind of investor. And then the incentives that management is getting paid pretty well by should be in line with what's creating value for shareholders. And now when we drill down into the culture, when I sit down and talk to management team, I kind of have some like questions. I want to see how they respond to them. And so I'll ask them questions like, how are you able to recruit talented employees to come work for you? Or how do you identify your highest performing employees and develop them and advance their careers? And I'm less interested in the answers they give me than in the change in their body language. Because if those kinds of things truly matter to them, usually the person will crack a smile, you'll see their body relax because they care. And that's the kind of thing they want to talk about, especially if it's a co-founder of the business who's still the CEO for these small cap companies. I want to see that the people of that business actually matter to the person running the business, and it's not just viewing employees as the cells on a CFO spreadsheet, like a cost. I want to see them cultivating the attraction and retention of good people. And so when we find CEOs who can communicate effectively with us why they want talented people, they're going to score well in our system. And I think why this comes into focus and matters, you need good people. If it's your sales reps, if it's your product developers, if it's your client-facing relationship people, you really need to have, especially in the small cap world, high-quality people in those positions. And we're trying to drill in and make sure that these companies have that.
Love that. And you're not just talking about the management team that's led by the chairman that you're meeting with. You're talking about meeting with the CFO. You're talking about meeting with president, COO, et cetera. How do you organize those kinds of conversations just generally? And then we're definitely going to be talking about ideas and specific stocks, but I want to broadly talk about process and construction, in the beginning here.
So when we sit down with the CEO and CFO, we are almost never talking about like the next quarter's results or like minutia down the income statement and, the kind of stuff that the street likes to write about when they're trying to guess if they're beat by a penny or not. We're trying to really zero in on how are you developing products? How do you decide something's a go or a no-go, for example? How are you talking to your customers to learn about what their needs are and build that into your product development process? Just really like take a business owner mindset and, make sure that they're also taking a long-term view with how they're investing in their business and their people.
One of the things that I've struggled with recently has been candidly management turnover in some of our companies. How do you deal with that as well? Because in your case, you might have been long a company 3 years ago, and then the CFO leaves. I mean, how do you address that kind of situation? Because that's life, right?
It happens all the time, especially in the small cap space, where if somebody does a good job for 5 or 6 years, they're looking possibly to move up. If you're a CFO and then you get the opportunity to be CFO at a mid cap or a large cap, they will often take that. So we have to decide with each of the businesses we own, who are the key people. Often it is not the CFO for us. It might be, it could be a visionary CEO. It could be a chief medical officer, the chief scientific officer. The sales roles are crucially important. Who's leading the sales organization? Have they structured that properly? Things like that. And oftentimes, and this is where the art of this business comes into play, you have to decide if it's a deal breaker or not. I tend not to like abrupt, unannounced changes, especially, if it's a sales role and then you're seeing like, next quarter, like a big problem happened. It's like, okay, that person got out before it got bad. And then you're like, this is probably busted. But if it's a CEO and they're, 15 years into the job, they hired somebody to be the chief operating officer 2 years ago, and you see it was like a planned, orderly succession, that's probably okay. But yeah, it's challenging.
Yeah, no, I tend to enjoy the conversation with chairman and look to the president or COO as the person who's executing on the plan. I actually don't spend enough time talking to the salespeople. I have to admit that. I'm going to drill deeper on that. I think it's important. You're right. So cool. I know. And I used to talk to the head of human resources as well. No, you always learn a lot when you're talking to the folks who are responsible for the execution more than the vision, right?
Right.
And people always talk about when you visit a company, what do you see in the parking lot, right? That's always kind of like the joy. How many Mercedes are there versus, VWs, right? The Porsches are definitely a red flag, right? So we're going to spend our time really focused more on TMFS, right? The small cap strategy, because that's your key responsibility. You talk among your portfolio managers and share ideas, but that's the portfolio that I think it's fair to say you know the best. Is that right? Okay, cool. Okay, so is there a top-down approach to it across different industries? You clearly have a tilt towards healthcare given your background and industrials as well. What should somebody be looking for in the way of industry exposure in this portfolio?
So when we built this ETF 5 years ago, we decided we're going to stick to our knitting as bottoms-up fundamental investors. And so the sector or industry group exposures, however people want to slice their classifications, is an outcome of doing our fundamental one stock at a time research and deciding we like a business and want to own it. That said, certain types of industries are more amenable to being viewed as high quality businesses than others. For example, in energy, it's commodity business by nature. Banking, it's a commodity aspects to that as well. So we tend to gravitate towards healthcare, industrials, a little smattering of consumer, a little bit of tech, and some financials to round it out. So we are going to look quite different than our benchmark, which is the Russell 2000 Growth Index, on the sectors and the industry groupings, but also from the number of companies we own. There's over 1,000 companies in the benchmark. We have decided to focus down. We feel like owning the 30 to 40 of our best ideas, and having conviction around what we own and wanting to own them for the long run is what's going to lead to the results we want.
So the fact that you're 22% now on healthcare and 27% in industrials and almost 19% in technology, that's going to maybe change, or is that, given the fact that you hold your positions for so long, or take a long-term view rather, it's not going to be static, but that's going to be somewhat the makeup on a long-term basis.
Yeah, I think that would be directionally correct to say what people see today is going to be roughly how things look going forward.
But then also, you mentioned your index that you're trying to beat. Your universe is quite big. How do you narrow it down to 35 or 38 companies? Do you get to 200 and then constantly have to sequence through to keep up to date?
Yeah, I wish I had a supercomputer brain to manage all those companies, but we don't. So I think all of the investors on our team handle idea generation a little bit differently. There can be some screening involved. We don't have a hard and fast rule. What does growth mean for our growth fund? I tend to want to see at least 10% revenue or 10% earnings growth is kind of like a floor. We're not here to own stagnant businesses in a growth fund. We want value compounders. So that's one screen. We kind of screen out terrible balance sheets. We don't really want, a lot of levered businesses. And a lot of businesses with terrible margins kind of don't make the cut either. That tends to be a sign of bad businesses. We want high return on capital businesses. So you start rolling through maybe some of those quantitative filters, and then also your quality from what you just over the years of studying different industries, you kind of know who the good players are, and those bubble to the top. And we build out our watch lists and, set our target prices accordingly.
Yeah. You just said something important. Set your targets accordingly. Targets do different industries have different targets in terms of their returns? Well, that's not the way you think about it.
That's a great question.
More bottoms up.
I think it's a little more bottoms up. We say, for example, we've got a high growth med device or software company that's probably going to have a high multiple on it. Might have different risk reward expectations for that name than maybe the tortoises of the group. We've got some of those too in different industries. Less high flying, but the growth is maybe a little more predictable. Multiples a little lower. We want to own a little bit of both.
Yeah. So let's jump in and talk about some of the tortoises and some of the other types of companies, if you would. Alarm is a name that, frankly, I think I've known for like a super long time. Glad to see it in your portfolio. Am I right to say that's a steady Eddie?
We kind of view it that way, but it's a little bit, it has been over its history at times a little controversial. Like, it's how does this home alarm business compete with like the more legacy incumbents like an ADT? There's also a lot of upstart disruptive single point solutions out of companies like Nest or SimpliSafe, or, there's the competitive intensity could be viewed by some of the bearish persuasion as a little high. And it's like, how is Alarm going to compete and win? But year after year, we find they do. And so they have holistic home monitoring solutions, and they've invested quite prudently, in our view, in the development of their products, getting into video, getting into analytics, trying to reduce false alarms that can happen when a raccoon runs across your yard, for example, just to distinguish between a person stealing your package and an animal wandering around.
Yeah.
So we think that they've been smart and intelligent to build out a residential monitoring solution, but then they're also taking that into small businesses, which, need monitoring on their back doors so people aren't trying to come in through the alleyway and bust into their safes. So we feel like they've done quite well in a tough field.
But the business model is that what drew you to the company, and is it still very fragmented as an industry?
Yeah, I would say it's still quite fragmented. And then the business model of basically charging a subscription fee for around the clock monitoring with video capabilities. But the fee was, more attractive than what the legacy players were charging for, dumb monitoring, which just detects if a window opens or a door opens. You get a better product at a better price.
So that's your second largest position. Your largest one is Goosehead, a name that I'm not familiar with at all. I guess it's in the insurance business. Talk to us a little bit about Goosehead.
By name, it's Goosehead Insurance. You would think it's an insurance company, but they're actually a broker. They have no insurance exposure directly at all. And this was a case of a business model disrupting the industry in a way we found to be attractive. So they do personal insurance lines, home and auto, but they're not selling their own home and auto like the big names everyone knows that have their own agents that only sell their own products. You see their ads on TV all the time. Goosehead will talk to a homeowner or somebody looking for car insurance and is able, as a broker, to provide them with the best policy for them, no matter who the ultimate provider of that insurance is. And what they have done is separate the insurance selling function from the insurance servicing function. So their agents just have to focus on getting business, sell the policy, and then they don't have to worry about the long-term management of it. Goosehead will do that. And as a key part of this model, they have a franchising model where these agents, it's like they brought franchising into insurance, which, a lot of investors love the capital light aspect of franchising models. An independent agent can sign up as their own boss with Goosehead, and Goosehead will basically handle all the back office stuff that they don't want to do, and they can focus on FaceTime with clients and selling policies. One thing that happened with Goosehead this year is they got added to the S&P small cap index, which tended to be a nice little bump for the stock.
Interesting. Yeah. So bump for the stock and you're watching it and you're knowing it's a short-term event. And what do you're just enjoying it, right? Because you're thinking long-term, you're looking at the business model and just, enjoying that bump. I was going to say goose egg, but I don't know if that's a good thing, goose egg.
And you've mentioned two of our top holdings. How it tends to work for us, we want to own companies for years. Our top 10 tends to be companies we've owned for a while that have grown into those positions. It's not usual for us. I'd say it'd be very rare for us to say, oh, we like this company right now, we're going to buy it into our top 5. And one of the reasons for that is the risk mitigation. We could be wrong. We want our companies to grow into big positions, kind of what we call the right way.
Yeah. So when that CEO gets that phone call from Charlie, they know, okay, he's got a real question for me. I better take that call, right? It's not just how's my quarter doing, that kind of thing. Yeah. No, I totally. By the way, along those same lines, there's a company called Accent Enterprises. What a winner! Congratulations. I know not everybody can identify a company like this, but your team did a great job. Talk to us a little bit about how the team found this company. What were the things that compelled it, and what drove the stock performance?
I have to give full credit to my teammate Brian Hinman for this idea, which he's followed for many years. People might not know what Axon Enterprises is, but if I tell you they sell tasers, like that's who this is. So if police officers, law enforcement using non-lethal devices, it's a taser. That is Axon. And so they started this business many, many, many years ago, just with actually that hardware device itself for officers to use to apprehend a suspect. But what they've done within the past 5 to 10 years is build a really nice software business on top of that. And so what they're doing is going to the police departments, they're putting the cameras on the officers, they're recording the video, they're storing it on the servers at the precinct. That's a subscription software model. You think hardware, low margin, one-off. No, they've put a really nice software business on top of it. And because they're the only game in town, there's no competitor to Taser that has any sort of credible market share. They've had they basically got this locked down. For a competitor to come in, tremendously high barriers to entry. They would have to convince police department or the military, one, that their device is safe, like you could use it to shock a person. It's going to do the intended thing of, temporarily destabilizing them without causing them injuries or worse, killing them. So Axon has this big body of data of real world usage about the safety and effectiveness of their device. I think like in the Warren Buffett terms of, if you had $1 billion, could you replicate this business as a measure of how defensible the moat is? You might not be able to do that here with Axon. And so, yeah, to your point, it's been a tremendous long run winner.
Yeah. So am I noting like a pattern here of a focus on devices that are solving a problem or providing a needed service? Is that fair to say?
A little of both. A defensible product or product line that can grow, has a big addressable market. We love the growing market share of a growing market story. But ideally with not a lot of competitive intensity, because then ultimately the margins are going to suffer.
Yeah. Well, just to balance things out, we're talking about things that you've been long for a super long time. Talk to us a little bit about your sell discipline too, because unfortunately, we're in a business where we have to manage both sides, right?
That's right.
Don't always go great,
especially in small cap land. A lot of these businesses stumble. So I talked a little bit about our quality process and the evaluation on the front end. Alongside that, when we buy a stock, the sponsoring team member has to write up an investment thesis, and it has to have the key trackable indicators, we call them. So it might be 3 to 5 things that really drive the thesis. And then there also has to be a write-up of the risks. And the reason we do that is so as the quarters roll by, we can see if the company's on track with the expectations we had or not. And if not, why not? And so this builds into like the front end of the sell discipline. So if we had an expectation that a software company was going to grow revenue 25% a year, develop new products at a certain cadence, and then we're a year down the road, they're growing at 10, not 25, product development delays, et cetera, we could go back to the original thesis and say, this was a bust. And the nice thing about having it in writing is that it's objective. When you're working on a team, people have ownership of the ideas they brought to the team, and we want it to be a non-emotional conversation about observable, tangible facts that makes it easier to have some of those difficult conversations. And it also helps to say, here's why this one didn't pan out, and we're going to remove it from the portfolio. One thing I do not like as a PM, like my pet peeve is, the company missed on these 2 or 3 things, the CEO turned over, it's down 40%, but man, it's still cheap. I'm like, hard stop. Like, that might work in a value fund, but for us, when a growth stock, for example, becomes a special situation, Like that's the worst place for us to be in as a growth fund. So we have to stay true to our sell discipline. And if the story's not playing out the way we thought, we have to rip the Band-Aid off and get rid of
Can you give us some examples?
it. We just had a company called Claris, which was within the consumer space, outdoor type of equipment, recreational stuff, a lot of consumer discretionary exposure. So, things like bike racks, bullets, etc. for outdoor people who love the outdoors. The thesis there was that this was going to be a business that acquired similar companies and kind of built up the brand portfolio that way. Like a lot of consumer-facing businesses, they ran into some demand problems lately, supply chain issues that hit margins. It's just been a rough hoe to go through, and you have to make the decision, like, is this an industry-wide temporary situation that's affecting everybody equally, or are there specific circumstances to the individual company that cause you to question the thesis? So the first issues that arose earlier this year was a restructuring of the management of the 3 separate divisions they had by the chairman, to try and, by all appearances, fix the operations is kind of how we viewed it. That's strike 1 for us. Strike 2 came not too long ago. The chairman made an unsolicited bid to buy what would have been, a third of the company's revenue, if not real, could have been even half of revenue and a larger part of operating profits, by wanting to take the ammunition business out of this. And I'm like, so instead of this being a bigger portfolio through M&A story, it became some sort of weird special sit where the chairman, who's a massive shareholder, and you're like, am I getting a fair price for this? I don't know. It's things just went not the way we expected, and we had to make the decision just to walk away and move on.
And Claris is on the smaller side of companies, right? How do you define small caps, by the way, in terms of market cap range?
Yeah, that's a great question. So we have small cap growth in the name of the fund, which means 80% of our assets have to be within small caps. Now we get to define what that means. We use the range of our benchmark, the Russell 2000 Growth Index, as the definition of small cap. Now, the biggest company in that index right now, I think, is Supermicro Computer, which is about a $15 billion company. So small caps today are a lot bigger now than they used to be. In practice, it's going to tend to be within that 1 to 6 or 7 billion market cap range is where the bulk of them are going to be. And then on the bottom side, within an ETF, we have to be very aware of the trading liquidity. I tend to prefer to see $5 to $10 million a day traded. Less liquid names could start to cause, a little bit of, it's not a problem if it's a good investment, but there could be some issues with your spreads.
Yeah, no, I get it. Especially when you're fully transparent, right? Which you guys are,
right?
Which is wonderful. So can you talk to us a little bit about John Bean Technologies as well? It's a name, again, that I've never heard of.
John Bean is an odd mix of businesses. So you have the food processing business, and then an airport business, which is, you walk onto an airplane from the terminal. You're sitting there at the gate, and you walk across the jet bridge to get on the plane. That's quite possibly a John Bean jet bridge. And then alongside that, they have food processing. So you take, a lot of the meat processing. There's some awesome videos on YouTube about how they use water at high force to cut chicken breasts into the right shape for the packaging. So it's on the food side of the business, it's a lot of application of technology for basically the automated high-speed processing of food, and a lot of it is protein. And so they've invested a lot in the technology for the monitoring of these machines, to make sure that the maintenance is as efficient as possible. Because you can imagine in food processing, if the line goes down, big problem, right? So you got all this food that needs to be processed backing up. That could cause a lot of issues for the company that's their client. So staying on top of the monitoring and the maintenance of those chicken cutting machines is a big deal. So they've invested a lot in the technology to make that happen. But yeah, it's a wild little conglomerate. It's kind of we like idiosyncratic businesses like this. They just tend to fly under the radar, and they can be sneakily good.
And when you put on a new position, well, two questions. What has been your most recent new position, right?
Okay.
And then how do you scale in? Do you start at 1% exposure and then build up, or do you just jump right in?
The average position size in the fund would be about 3%. And that's probably going to be something we've owned for a while. We like to come in slow with a new idea, usually about 1%, with a combination of pricing and execution against our thesis points, determining the pace at which we're willing to add and build that position. So yeah, well, like every other investor, we'd like to buy on dips, but that has to coincide with the business doing what we thought it was going to do. And then we'll build it up into a more meaningful position. Aspirationally, with a focused portfolio, I want to love everything we own. And to me, that means we should own everything at least 2% or more. I don't like a lot of little positions hanging out there. We've got a handful of them. Some of them are new, right? So they're there for a reason. But we find doing it slow and steady is good for risk management. Make sure if we're going to be wrong, let's be wrong small and find out early. And so I think the newest name we've added to the portfolio is a company called Toast, which anybody who likes to go out to eat has probably come across the server carrying the Toast handheld, so they can charge your credit card at the table instead of walking your card back to a standalone terminal. Or if you're at a more quick serve counter like a coffee shop, they'll flip the screen over and you punch in your tip and sign. That's very likely a Toast product as well. So they're in about 80,000 restaurants in the United States, but they provide a whole other suite of services for that restaurant besides just the payment processing. They can help manage reservations. They can help manage a wait list. They can help schedule staffing. They also have a capital operation. So if a restaurant wants to buy kitchen equipment, they could go to Toast Capital, and then Toast will get paid back daily from a percentage of revenue, which is a nice little offering to have, to be able to talk to restaurants, because banks often don't like to lend to restaurants because of the failure rate being so high. But Toast has incredible visibility because they're the one processing the cards all day. They know exactly what's coming in to that restaurant, and if they take a percentage of that to get repaid over the course of a year, they've got the data. So they have built this to basically be the operating platform for a restaurant, from inventory to supply to staffing, all the way to the front to the reservations, the orders. So there's their average customer, I think, has 6 modules from Toast. And so that's a recurring revenue SaaS business. And then they also get a cut of every payment that's processed as well. So there's 2 revenue streams for them.
So again, is this like a device software company? Is that the way you look at it? Yeah. And when you're looking at that company, how do they distribute it? How do they get market share?
It's very competitive. I mean, there's incumbents in there from NCR and Oracle, but there's also a lot of startup, younger businesses as well. And so, there might be a dozen, 10 or 12 legitimate competitors in this space. And so people are familiar with maybe like Square, how you have that little, stripe swipe that plugs into a phone or a tablet or a Clover, in addition to those bigger players. And we spent a lot of time looking into the competitive landscape and trying to figure out, why is Toast growing so fast when their landscape is loaded with other companies trying to do similar things? We had to really figure that out. And one of the reasons we think they've been successful is that they, one, were purpose-built for restaurants with their own hardware, their own software. They built this to meet the needs of the restaurant operator versus trying to glob on from a legacy system and bend it to the needs of a restaurant. The other is on the Salesforce side. It's all local people who know the local restaurants. So somebody opening a new restaurant knows all the vendors in their area as it is. There's a lot of word of mouth. Oh, who should I use for my systems? Oh, go talk to this person. So they've got people who know the local markets, people who know the restaurant very well, and they're able to go in and win that business. I think they're actually looking through the RFP process that, like a restaurant organization that maybe has 30 restaurants, they'll go through a pretty good RFP process. We found that Toast is very willing to go the extra mile to be successful in those RFPs, where some of their competitors are like, you know what, you're just asking too much of me without committing to my business. No, I'm not going to let you demo my products for 30 days. Because it's onerous. Like, we're not going to come in 3 days to your HQ and show your team how this works over long days. Toast is willing to go that extra mile and win those contracts. And I think it's just little pieces across the business is how they're able to be successful. But yeah, that was the big question we had coming in was, is this a commodity where like anybody can provide a payment terminal, anybody can do staffing or reservations, et cetera? And we decided that no, there was enough here that they've got an edge as a business, but it was a lot of work to get there.
Yeah, you're talking about a subject that is near and dear to my heart, meaning the restaurants. Charlie, you're probably not aware that I launched a restaurant ETF.
Really?
In 2016. So I'm familiar with the industry, and I think, and I could be off on this, but Grubhub, is that a name that you were familiar with in the past that maybe you sold?
That was a paid point, well, no, it's good to talk about actually. Grubhub at the time we bought it was mostly an online ordering company for somebody to walk up to the restaurant and take their order and leave. And then delivery got added on. And then SoftBank-backed startups with infinite resources came in a very uneconomic way and just made a land grab. And that's DoorDash and Uber Eats. And Grubhub just got obliterated. And this is me. I'm going to take ownership of this. This was my idea. I brought it into the fund. Is not recognizing how quickly Grubhub was going to lose its number one position and how bad the economics were going to get. So the thesis deteriorated with it. I mean, it was quick, within a quarter or two. And I was slow to recognize it because I was latched on to, oh no, Grubhub was seamless. They're doing great. And of course, they're trying to run this business in an economically responsible manner. And I'm like, what DoorDash and Uber Eats are doing, that's not sustainable. They can't keep doing that. Rationality will prevail. And it did not.
Yeah, it was a moment in time where everything was moving so quickly. Capital was so cheap. People were afraid to lose money or not afraid to lose money, right? And and it was very hard to keep up with. I totally get how one would get snookered. Don't get me wrong. So UFP technologies, let's bounce around, right? Healthcare is an area that you got an expertise in, right? So talk to us a little bit about that one as well. And also, at some point, your winners have to be resized, right? I mean, how do you go about giving a little bit away to the market because maybe it's gotten too big. And I don't know if that's the case here, but
I'm actually going to have to punt on that one. That's my analyst, Ben Long's idea. So
okay.
He's our healthcare guy. But you're right. So as part of the sell discipline, one, valuation comes into play, two, position sizing. And so the winners, they get big, right? And so we like to be very slow to sell the winners. I think if you look at the data, right? So if you have a market cap weighted index, the winners drive the bulk of the returns over long periods of time. We think the same is also going to be true in an actively managed fund like this. Over a 5 to 10 year period, we're all going to look back at these funds, or you can look at ones that have been successful. Often it's a few winners that really drove the performance. And so they're hard to find. And when we have one, we love it and don't want to let it go. Now, the problem is, what do you do with, you want to have a responsibly diversified portfolio. You don't want to have, you may not want to have a name be 10 to 15% of your fund. The daily volatility could drive your clients crazy. But then we're also in a small cap product. We want small caps to turn into mid caps. That gets problematic for us keeping them. And so that's another reason, we want to, ride that ride as long as we can. Play a little bit with that 20% of the fund we can have outside of small caps to keep them because we think it's in the shareholders' interest. But ultimately, we're going to have to trim and let them go.
And in the case of it being an ETF, this isn't tax advice, but generally speaking, because it's an ETF, there will be a capital gain distribution, which is great. So I hear you, and yeah. So we'll leave it at that. And am I missing any particular holdings that maybe you would want to highlight? I haven't asked about Q2 Holdings, which is another one of your bigger holdings.
Yes, but I think I might want to touch on the one right under it in the ranking, which was health equity.
Okay.
And the reason I want to do that is, do you know the HSA market at all?
I do not.
Okay, so this is health savings accounts.
Okay.
So,
that I'm familiar with. Yeah.
This is a benefit offered by companies as a way to manage rising healthcare costs. It shifts some of the cost of that onto employees. But the benefit is an HSA account is almost like having an IRA. It can be. The employee sets aside money, and if they don't use it for health expenses, it grows tax-free. So HSAs have been growing very rapidly over the last 10 to 15 years. There's a lot of room left to run there. The HSA bulls will say this should look like the 401k or the IRAs, where it's that widely adopted. And then, so we have that growing market, and Health Equity on their website shows a great picture of like their 10 to 15 year history, where they went from being the number 5 or 6 player, 15 years ago, whatever the number is, to the number 1 player today. And that's by accounts and that's by assets. And they did this by buying up subscale HSA providers, usually from banks. You get to a point in a consolidating industry where players number 6, 7, 8, 9, 10 realize we're too small to compete, and they start selling to the top 3 or 4. And that's exactly what's happening here. So Health Equity is the number 1 provider, is very slowly helping consolidate this industry by making these tuck-in acquisitions. And by doing it for a long time, they're now the number 1 player. In the current market environment, higher rates for longer, that benefits Health Equity. They're basically not just an HSA provider, but assets within those funds. They're also an asset manager, effectively. And so there's higher rates of yield that they're able to keep on those assets that are just sitting there in those HSA accounts. So it's every time rates go up, it's a benefit for Health Equity.
And financial advisors can sell HSAs, right? Yeah. No, I think I've spoken to a couple of advisors who, are building up assets as a result of it.
Yeah.
Who should they be calling, by the way? I think that, yeah. Well, this has been a lot of fun. You know, I have like a real random question.
Yeah.
That one of the advisors on the call asked that I'm interpreting a bit different than what he was asking. I hate it when somebody shorts one of my long ideas, right? And I think, quite honestly, it's okay that they're shorting it, in that that means at some point they have to cover it. And usually a short thesis is, tied with a near-term catalyst. How do you view when you hear a story about a short on one of your names? How do you handle it? What do you do? And you can't ignore it, right?
Right. First off, start with a place of humility that I might be wrong, and be open-minded to what they have to say. If they found something in the numbers or in the market analysis that we missed, I kind of want to know. I would rather know I was wrong than live in incorrect, blissful ignorance and, keep going. But sometimes the short sellers are wrong. We've certainly had cases where, you get these 90-page presentations and we're like, your math is wrong. So we'll go through their work and, give it a thorough comb over to see if they're right or wrong. But we don't take it personally. And often if they are right, it's a time difference, right? They could be right that the next quarter is going to be terrible. We could be right that the 3-year outlook is awesome. So it's not necessarily mutually exclusive either.
Yeah. No, I think that I hate it when there's a short interest on my name that's increasing. It makes me nervous. But it also makes me more aware, right?
Right.
So and we live in a two-sided market. So it is just simply reality, right? So I'm glad that question popped up. Listen, Charlie, this has been a great discussion. Appreciate all your effort, right, in block and tackling, et cetera, in building the portfolios that you do. Any last minute thoughts? Is the website the best place to find out about your firm and your funds?
Yeah. Thank you for the opportunity, Dan, to talk about our funds and what we do here. And fooletfs.com would be the best place to get more information.
Good. And I guess it's okay for them to reach out to you on LinkedIn as well.
That should be okay. Yeah.
Okay.
Just don't ask for stock ideas. I can't do that. But
no stock ideas. But you are what you're long, right?
That's right.
Buy the fund.
Our portfolio is up there every morning. So
okay. Well, thank you very much, Charlie. Look forward to more engagement and more discussions, and appreciate your participation in the ETF think tank.
Great. Thank you very much, Dan. Have a great day.